Hey, good morning, everybody. This is Dan with Theta Trend. Today is Thursday, December 17th. It's about 6:45 a.m. Mountain Time. So that's about 8:45 Eastern Time. And the market opens here at 7:30, so we're about 45 minutes before the market opens. So today in this video, what we're going to do is I just want to walk through the entry criteria a little bit. We're going to talk about the market and look at how I evaluate the entry of a core income butterfly trade, the CIB. Before we do that, we just need to go through the disclaimer real quickly. Essentially what this says is Theta Trend is not a broker-dealer or an investment advisor. This video is for educational purposes only. You can lose money trading options, so be aware of the risk of loss and understand what you're doing. Trade with a plan, use good judgment, and of course you can always see the full disclaimer out on the Theta Trend website. So with that, let's move into the meat of the video. I'm going to just close this out here. Yeah, we'll save that. Okay, so what we're looking at here, this is a weekly chart of the Russell 2000, the RUT. And this is a longer term chart, a longer term trend. And so here you can see this was the the financial crisis. The market crashed back here in 2008. This is the low in early 2009. And this is where we are now, today, way up here. And what I've done here is I've drawn a couple of trend lines on the chart. And this is just to create some longer term perspective because the market's been really volatile lately. And there's a lot of question about what's going on. Is the market going lower? Is the market going higher? Most people seem to be in the camp that the market is going lower. I'm one of those people, but I'm always bearish. So, take that with a grain of salt. But at any rate, we have this longer term trend line that comes back here from the 2009 low. The market comes down, touches it there, and it's sort of hovering above it at this point. We have the secondary trend line that starts back here. What year is this? It looks like this is 2011. And the market has respected this trend line for some time here until this recent crash in August. And after that crash, we've really failed to get back above that. And so I suppose one of the next obvious levels of support is probably going to be down somewhere in here, along this trend line, which is around, we could call that 1040 down to maybe 1,000 or something like that. Obviously, the trend line continues to rise. But for the time being, this level here, kind of this 1090-ish area, we could call that 1080 to 1090. This has held as support for some time. The market broke down through that to test it, hit that trend line, and came quickly up out of that. That was last October. And even in August of this year, we came near that level, the 1080, 1090, and we got to bounce back up off of there, hit the underside of this rising trend line, and the market, at least this first time around, has been rejected at that level. So in my mind, we're in something of a neutral to longer term bearish situation. In general, when the market remains underneath, this is the 40-week moving average, which is approximately the same as the 200-day. When the market gets trapped underneath this 200-day moving average, the moving average starts to turn over. Usually what we see is something bad happens. The price continues lower fast and things get ugly. And that's kind of the scenario I expect to play out. But in the short run, we could certainly have a rally back up here. We could come down and fail and go back higher. There are a lot of different things that could play out, and we just don't know. Those short run scenarios are what create questions. So if we come over here, now we're down to a daily time frame. And yesterday we had the Fed announcement. The Fed said that they're going to hike rates, and we got this continuation, this big move up higher after that. I guess that's good news. I don't know. I don't put a lot of creed in the news, but, it's good to know when those events are taking place. So the market is below this 50-day moving average, which is rising. And again, it's below the 200-day moving average here. So, in general, what I see is a lot of confusion. And I'm just not real sure where the market's going. Most of the time when I am sure, I'm wrong. So, keep that in mind as well. But from this, what we can see is that there's sort of this area from, maybe the 1120-ish up to, right around 1200. And the market more or less has been in this range for some period of time. And so what we're going to do is go even a little bit closer here. This is the 65-minute time frame. And what we're looking at now, this yellow moving average, this is the 5-day, the red is the 10-day. And so what we're looking at is a situation where the market's kind of been trapped in this range, this darker shaded area for some time. Going back, this is the market falling down here in August. Then it quickly came back up, found the bottom of this channel, and it's more or less been respecting it. There have been a couple of moves lower here. The market attempted to break down. It failed, and when it failed, it quickly came back up into this area. And this sort of the same thing late last week. We had this failure out of the range, and then this rally right back in. And this was something that I said in the weekend market commentary, that I wouldn't be surprised to see a rally to the 1140, 1145 area early this week, and obviously we exceeded that. So at any rate, we're kind of on the lower end of this range, and we could say maybe the market has the potential to go up into the neighborhood of 1200 or something like that. And since we're starting to get back up in here, we're also about 60 days away from February 2016 expiration. I'm starting to look at the CIB and think about entering the next trade for the February cycle. So what we have here, I've jumped over now to the risk graph, and what we know is the market closed yesterday here at 1149, basically. Let's just call it 1150. The futures are trading up about 5 points this morning. So maybe we're expecting to open somewhere around 1155. And I'm saying that, the market's basically in that 1155-ish area. So knowing that, I'm going to be looking at the February 1140 Rut Butterfly. Let me just go ahead and uncheck this IWM call. And if we look at the options expiration chain, we see that February has 63 days to expiration. So it's a little ways out. It's a little bit early to enter this trade, and I feel okay with that. I feel comfortable, and it's personal preference, but I'm ready to enter the trade. So at any rate, I'm looking at this 1140, 1190, 1090 butterfly, and the price at the close yesterday is 1060, and that's pretty close to that recommended profit and loss target for the CIB. And if you recall, that's the profit loss target is 25 to 33% or so. And the way that we know is, let's suppose that this butterfly costs $10. It doesn't, but it's easier math. So if the butterfly costs $10, we know that the strikes here are 50 points wide, the 1090, 1140, 1190. So if they're 50 points wide and we pay $10 for it, the most that we can make, if everything is perfect, if we're totally perfect and it expires at 1140, is $4,000. So the risk on this position is 10 or $1,000. So 1 divided by 4 is 0.25, so about 25%. And so we know that this 1060 is right around the, kind of the price that we're looking at, and that's how we evaluate the trade initially. In looking at this butterfly, the delta is short about 4.5 rut points or so. So we're going to be looking for an IWM call that has slightly less than, somewhere around 40 delta, something like that in IWM deltas. So we're looking at here, this is the IWM call, and when it's weighted out to the rut, it's 3.92, so it's about the 39 delta Feb 117 IWM call. So if we add that to the position, we end up with something like this. And this would be the initial trade. Theta is relatively low because we're 63 days out, so it's under $5. We could just basically call it $5. Our delta is pretty flat. If we trade quickly up to that 1180 area, we'll be down a tiny bit of money. And if you recall, the higher point of that range was right around 1200. So what I know is that if the market does trade up into here to this 1185, 1190-ish area, we're going to be adding another butterfly, probably the 1160, and that's going to stretch out our expiration risk graph a little bit and give us a little bit more room to run, probably up into this area, to the 90-95. So if the market does race all the way to the top of this range that we were looking at over here, we're going to be making some upside adjustments. It's going to leave the body of the butterfly right here at about 1180. All right. So if we get up into this area, that's this is kind of the adjustment add point. So I feel pretty good about the location of the butterfly, and that's one of the other reasons I'm willing to enter it right now. On the downside, we are looking at right around 1110 is going to be our roll point. So if we enter the trade and the market trades down to this 1110 area, we're going to be closing this out and we're going to be reopening it down here somewhere. So let's go back over and look at 1110. So 1110 is down here. So basically, if the market runs up and then crashes down through this level here, then we're going to be in a situation where we need to move the butterfly lower. So I think this is a good starting point for the trade. The position's always moving around and things like that. It's never static. It's adjusting based on whether or not the market goes higher, the market goes lower. And frankly, I'm pretty bad at predicting the direction, so I'm always moving it around. But that's it for today. I hope that helps. It's just sort of an overview of how I look at trade entry for the CIB. And if you have any questions, feel free to shoot me an email. My name's Dan, and info@thetatrend.com. Thanks for watching.